Hello and welcome to the Ditto educational series that will provide you with the skills you need to become a Forex trader. Today we are going to be discussing central banks and how they affect the Forex markets. Central banks' main objective is to maintain inflation in the interest of sustainable economic growth and by doing so contribute to the overall stability of the financial system. Central banks are independent institutions utilized by nations around the world to assist in managing the commercial banking industry. Set central bank interest rates promote financial stability throughout the country. When central banks need to preserve order, they will intervene in financial markets in line with a defined monetary policy framework. The implementation of this policy is widely monitored and anticipated by Forex traders seeking to take advantage of the volatility that will ensue because of it. We will now look at the roles of the major central banks and how their policies affect the global Forex market. Firstly, we have the open market operations. Open market operations, or OMO, describes the process whereby governments buy and sell government bonds in the open market, with the aim of expanding or contracting the amount of money in the banking system. The purpose of this would be either to stimulate or inhibit growth of the economy to maintain balance. Next we have the central bank rate. The central bank rate, often referred to as the federal funds rate, is set by the Monetary Policy Committee with the intention of increasing or decreasing economic activity. An economy that grows too quickly can lead to inflation, and a central bank's aim is generally to preserve the economic equilibrium. Central banks can also act as a lender of last resort. If a government has a modest debt to GDP ratio and cannot raise money through the bond auction, the central bank can lend money to the government to meet its temporary liquidity shortage. Having a central bank as the lender of last resort increases its investors' confidence. Investors are more likely to believe that governments will meet their debt obligations, and this helps reduce government borrowing costs. Let's now take a look at some of the major central banks. The European Central Bank, or ECB, is different from other banks in that it serves as the central bank for all member states in the European Union. The ECB prioritizes safeguarding the value of the euro and maintaining price stability. The euro is the second most circulated currency in the world and therefore is keenly observed by Forex traders. Next we have the Federal Reserve Bank. The Federal Reserve Bank, or the Fed, has implications not just for the US dollar, but for many other currencies as well. News and actions surrounding the bank are observed with great interest. The Fed specifically targets stable prices, maximum sustainable employment, and moderate long-term interest rates. Next we have the Bank of Japan. The Bank of Japan is unique in that it has prioritized price stability and stable operations of payment and settlement systems. The Bank of Japan has held interest rates below zero in a drastic attempt to give new life to the economy. Negative interest rate actually allows individuals to get paid to borrow money. On the flip side, investors are disincentivized to deposit funds as they will incur a charge. Bank of England. The Bank of England operates as the UK's central bank and has two main priorities, which are preserving monetary stability and financial stability. The UK operates a twin peak system when regulating the financial industry, with one peak being Financial Conduct Authority, the FCA, and the other the Prudential Regulating Authority, the PRA. The Bank of England regulates its financial services by requiring these firms to hold sufficient capital and have an adequate risk controls in place. Central bank responsibilities. The purpose of central banks is to fulfill a mandate in order to serve public interest. Their responsibilities vary, however, they all share a few common goals, which include 1. Supervising and regulating financial institutions, 2. Promoting financial system stability, 3. Fostering balanced and sustainable growth in an economy, 4. Achieving and maintaining price stability, 5. Minimizing unemployment. Central banks and interest rates. We discussed central bank interest rates in a previous video, but to quickly recap as they tie into this branch of knowledge, central banks set the central bank interest rate, and all other interest rates that individuals encounter, such as loans, mortgages, credit cards, and so on. The central bank interest rate is the interest rate that is charged to commercial banks looking to borrow money from the central bank on the overnight basis. Commercial banks charge a higher rate to individuals than the rate they can secure with the central bank. Commercial banks need to borrow funds from the central bank in order to comply with a modern form of banking called fractional reserve banking. The bank generates revenue through this process by charging a higher interest rate on loans while paying lower interest rates to depositors. Forex traders will monitor central bank rates closely as they can have a significant impact on the Forex market. Institutions and investors tend to follow the interest rates, and therefore changes to the interest rate will result in traders investing more towards countries with higher interest rates. The language that is interpreted to suggest either an increase or decrease in rates is referred to as hawkish or dovish. As if there wasn't enough jargon to learn in Forex, it is important to remember. The subtle clues that this language leaves behind are referred to as forward guidance and have the potential to move the Forex market. Traders that determine the central bank is about to hike an interest rate and perceive the outlook as hawkish will place a long trade in favor of that currency. However, traders anticipating a dovish outlook from the central bank will look to short the currency. Central banks will not outright announce whether the outlook is hawkish or dovish, so what are we looking for to determine this for ourselves? A hawkish stance is guarding against inflation to get high. To curb inflation, a hawkish policy will increase the interest rate or some other equivalent action. An increase in interest rates can cause a strengthening in a country's currency. Dovish is the opposite of hawkish. This is when the economy is not growing and the government wants to guard against deflation, which is the decrease in the cost of goods and services. So basically, we're looking for signs that they want to do something to stimulate the economy, such as lowering interest rate to increase the rate of purchase on goods and services. As we trade pairs in Forex, we are looking for currency pairs with a large directional potential. If one currency is strong and the other one is weak, the rate at which the pair can rise and fall may be substantial. Pairing this knowledge with your technical analysis can see you make superior trade choices and improve your overall trading. Hopefully today you have enjoyed our discussion, ladies and gentlemen, and now have a greater understanding of fundamental analysis. Please sit back and contemplate what you have learned today, and remember, contemplation is the key to learning. Thank you for watching the video. If you enjoyed our educational sessions, then please like and subscribe.